The European Central Bank's Governing Council will meet again on Tuesday to decide what to do next with interest rates. It comes as pressure grows on banks here to pass the benefits of the cumulative rate increases since last year on to savers via higher deposit rates.
Since last year, the European Central Bank has raised rates by 4.5% to tame inflation. Mortgage holders think they're feeling the full effects, but savers argue they're being shortchanged. Latest ECB data shows in October, mortgage borrowers here paid 4.25% interest on average, the 8th highest in the Eurozone, while depositors were receiving 2.6%, the 6th lowest in the Euro bloc. But since May last year, Irish mortgage rates have actually only risen by 1.5%, the second lowest increase in the euro area, while in contrast, deposit rates here have climbed nearly 3%. A lag between ECB action and bank reaction is a factor, while many mortgage holders are also on fixed rates.
A lot of people on those contracts, they are short-term in nature, and as they begin to come off, we'll see mortgage holders facing a higher repayment burden over the medium term.
Irish banks already have large deposit bases and therefore don't really need to attract a lot more. But it also means they don't need to borrow so much on expensive wholesale markets, which helps keep mortgage rates lower.
We kind of need to be careful what we wish for. We probably can't have the best of both worlds. We can't probably have really, really low mortgage rates and really, really high deposit rates. It's probably going to kind of be one or the other.
Reduced competition in Irish banking also plays a role. Lenders also appear to be strategically shielding the 720,000 mortgage holders from the full effects of rate increases to prevent arrears.
The banks themselves have pretty much said we're trying to keep mortgage rates as low as possible so that people don't go into arrears, so that people don't fall behind on their repayments. But the upshot of that is that we're not going to have deposit rates that are quite so high, and I kind of think that is the right solution.
But can highly profitable Irish banks not afford to offer more generous rates?
Bank profitability and capital are two sides of the one coin. If you don't have profitability, you don't have capital. If you don't have capital, you don't have new lending. If you don't have new lending, you don't have new investment.
There are some higher yielding options available to savers unhappy with the return they're receiving. The advice, as always, is to shop around. Will Goodbody, RTE News.